And welcome to our class, The Trend is Your Friend. This is Barry Norman on behalf of ETX, and welcome to tonight's webinar. Now, for those of you joining us for the first time, ETX is a regulated provider, so I'm required by law to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds you cannot afford to lose, and seek advice if you do not understand the risks. ETX Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned tonight are for educational purposes only. Now, for those of you that are joining us through the internet, just through a web search, ETX is a regulated provider, and we're a fast-growing financial services company based in London. You're welcome to come up and visit our offices, or you can see us a lot of times on BBC or Sky while they're interviewing our staff and our in-house analysts. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we are also a member firm of the London Stock Exchange. We offer many different ways to trade on our platform. You can trade using our web-based ETX Trader Pro platform. Means you can log on from anywhere, there's no downloads, and you can easily make your trades quickly and successfully. Or you can move to our more advanced trading using our MT4 platform. You can download it, you can add all the expert advisors you want to it, you get advanced charts, and you can even set up your own automated trading system. You build it, you trade it, you do whatever you want with it. Or if you're a beginner, you might want to start with our ETX binary platform and start learning how the markets move. Or you might want to incorporate binary options into your other trading strategies. There's many ways to use our platform and all of our different styles of trading. And if you're not sure, contact your account manager at ETX, and they'll be glad to show you or demo any of the platforms for you. Now, tonight's class is The Trend is Your Friend. It is one of the oldest sayings in the marketplace and one of the truest. If you've been trading for any time, you would have heard the saying, the trend is your friend. And the fact is that it is. Any successful trader will tell you that trading with the trend is always more successful than trading against the trend. But in order to do that, you have to establish a good, viable trend using rules and guidance. So let's talk tonight about what a trend line is, what the rules are, and how you would put a trend on your charts. Now, learning how to read a Forex chart or any advanced chart is considered to be somewhat of a science. They look complicated at first glance. Forex charts can look drastically different depending on what options you want to use. Charts usually have settings for display styles from the price and the time frame and how you want to view it. Time frames can vary anywhere from 1 second to 10 years depending on the charting system. Prices can be usually displayed as candlesticks, bars, or lines. So there are three basic types of charts. We have a line chart, a bar chart, and a candlestick chart. And the reason that you want to understand what charts are, and if you're not sure about charts, you can come to our class on basic charts. But charts are a roadmap to your success. And once you've understood a chart, you can start building or adding the lines and the information to these charts that will help you make good decisions or help you understand what's going on in the markets or tell you price points that you can expect some type of reaction or price levels that will be important to other traders around the world. Now, a bar chart, which is my favorite chart, provides more detailed information compared to a line chart. It not only shows closing price, but it consists of the opening, the high, the low during that time period. For example, if you use a 5-minute chart, it means that every price movement within the 5-minute period is represented by one single line on the chart. Now, I like the bar chart for building my technical analysis. Okay? Because with a bar chart, you can start visualizing how price is moving. You can see common areas and common price points that you can see where the market reacted, where the open, the close, or maybe the high or the low had some type of common price point in their movement. Like you see right here, look at how many times price in that period hit this level. Okay, sometimes it was the open, sometimes it was the close, sometimes it was the high, but that was a strategically important level. And if you bring price forward, you can see how many other times that price was very important. And a bar chart helps you easily see this information in an easy visual fashion. It's also one of the best charts to use to draw your trend lines on. Okay. Now, today, a lot of people are more into Japanese candlesticks because they become so easy with the new charts. And with the new charts, you can start with a bar chart, draw everything on there because it's a common, clean way to use, and then click over to Japanese candlesticks. So remember, on the bar chart, you see the open, the high, the low, and the close. So now, once we've got our chart, we need to start adding information to these charts to help us make trading decisions. And to me, there are three things that every trader should have on the charts. Okay, whether you're using them to make trading decisions, whether you're using them for technical analysis purposes, or you're just looking at your charts to understand price action. But there are three main pieces of information that, regardless of what system you're using, what strategy you're using, you should always be able to put on your charts, because they will help you determine exactly what's going on. This is trend lines, your support and resistance lines, and volume. So these are like the three backbones, or the three parts of the skeleton that you would put on your chart before you start putting on the skin, and you put on the hair color and the eye color and the makeup and personalizing, customizing. These are three crucial pieces of information. So tonight we're going to learn how to properly put a trend line on a chart. We also have a class that follows this. I think we're doing it next Wednesday on support and resistance. Because again, regardless of what system you're going to use, these three pieces of information, support and resistance, trend lines, and volume, are critically important. And these three pieces of information aren't somebody's analysis. They are three pieces that will help you to figure out what price points are important to other markets. Because a trend line has very definitive rules. Okay. After you go through trend lines and support and resistance and volume, the rest of the stuff, you can adjust the rules all you want. You can come up with your own system. But see, a trend line, when you have definitive rules and you draw these trend lines and validate them using these rules and guidelines, you'll be drawing the same trend line on your chart as 1 million traders around the world. And if you can put your trend line on correctly, you can then predict what price is going to be important to the markets. Not whether the market's going to go up or down. What price will you expect some type of action from the markets? When you can predict when the euro is climbing, the next price that's important will be 111.07. You can sit back and wait to see what type of reaction you get at that 111.07. If you're drawing on your own homemade, customized, unique trend line, you have no idea what prices the market should react to. And what happens is all the traders around the world are reacting to 111.07, and you're sitting there because you're expecting a reaction at 111.10, and you missed the whole thing. So trend lines are a useful tool for visually highlighting a trend and potentially being part of a trading strategy. There are lots of myths and inaccurate information about trend lines, though. Learning how to use trend lines effectively, if you're going to use them, is crucial so you don't fall into some of the common traps. Trend lines are a technical analysis tool used to define and project price trends in major markets such as stocks, forex, futures. Any market that moves has trend lines. Trend lines have the potential to alert us when a pullback is over or the trend is resuming, or when a trend is accelerating or reversing. Price is the ultimate indicator though. Therefore, price action must always be considered when using trend lines. Trend lines are drawn on a chart to help predict the general direction of price. They also help you see reversals. Trend lines also help to determine good entry and exit points and will help you decide where to put your stops. Well, maybe these should be called magic lines. Well, not quite yet, but they are really good. And they are, like any form of analysis, if used alone, they won't make you many pips. However, they will make a great addition to your trading arsenal and your understanding of the markets. The main problem with trend lines is placing them on your chart. It can be a little intimidating to start with, but it is quite easy to get the hang of it. So, the purpose of drawing trend lines is to identify where possible reversals will take place. They can also signal a change in the trend may occur. In an uptrend, you draw the line along the lowest points in the trend without letting the line cross through any prices. You need at least 2 touches of the trend line to call it an actual trend line. So in other words, you're in an uptrend, you draw your trend line underneath the prices because it's supporting the prices above. In a downtrend, you do just the opposite. You draw it above, and again, it is supporting the price as it falls. So it is in fact complicated, but you have to follow the guidelines. Now there are two main types of trends: uptrends and downtrends, bullish trends and bearish trends. So what you do to find in a bullish market, and again for a bearish market, it's just the exact opposite. You have to locate what's called the swing low. The swing low is the lowest point that the price touched before ending the previous downtrend. When a price is moving down, it's going to at some point turn upward. That point is called the swing low. You then extend that line forward on your chart without allowing any other price to break the line you're drawing. So in other words, if you were drawing the price here because you thought that was the uptrend, it isn't the uptrend because price broke through that line. Price can touch the line, but it cannot ever break through. Otherwise, you have to redraw your trend line. You must connect at least 2 points in common when drawing the trend line, but a trend line is not valid until it has a third touch. So you have an accurate trend line, but you could find lots of places to draw 2 points, but the trend line has to validate itself by having a third touch. The more times that price touches that line, that trend line, the more valid the trend line is. In a downtrend, is exactly the opposite. Okay. Now the trend is your friend, but like all friendships, it's a complicated one. Unless you understand the nature of a trend, your friendship is destined to fail. As any trader quickly realizes, there is a great deal more to trading successfully than merely identifying a securities trend and buying pullbacks in an uptrend or shorting bounces in a downtrend. But you have to understand the basics. So let's begin with the basics. An uptrend is a series of higher highs and higher lows. So in other words, price moves in pushes and thrusts. Now, you have price pushing, easing back down, pushing back up, easing back down, and pushing back up. There are 3 different types of trends. You can have sideways trends, which a lot of us call congestion. You can have downtrends, or you can have uptrends. But in each of these cases, push, ease, or they're the peaks and valleys that price moves because price doesn't move in a straight direction. Traders push it up, then they ease back a wee bit, then they push it back up. And there are trajectories of a trend. The steeper and the more valid the trend line is, that if each one of these pullbacks, okay, there are some rules on the pullbacks, and we'll talk about them. But you can see, like in this is a beautifully shaped trend. Okay, and it's got nice momentum. But you can have a trend that's erratic and weaker, or you can have a very steep trend. But it's important once you've got your trend line on to understand the difference. Because when you have a well-formed trend, your trend line works much better. So a downtrend consists of lower lows and lower highs. A sideways trend is a trading range in which the price of a security swings back and forth in a sideways trading channel. The three major types of trends are shown in this figure here. Conventional wisdom tells traders to buy in an uptrend, short in a downtrend, and buy up the lower end of a sideways trend, and short off the upper end of a sideways trend. So uptrend in a sideways trend, you can look to sell here, buy here, sell here, buy here. In a downtrend or an uptrend, the motto is the trend is your friend. You should never trade against the trend. So in other words, a lot of rookie traders wait for this and they want to sell into this. Okay. But the fact is they should have bought into this and realized that this was just the ease so that they could have bought into this and rode it all the way up. Okay. But you'll see that if you sell into the ease, you'll only make a few pips. You're better off buying into the uptrend because what you won't necessarily lose your trade selling into an uptrend. You'll make a lot less pips. So a lot of times your risk management rules say there's not enough profit to be made. You'll find you make more profit trading with uptrend statistically than trading against the trend. But first you have to learn to get your trend line on your chart properly. So let's talk about some of the rules of building this trend line. Let me get my marker off here. Okay. There are two major obstacles that you will run into when trying to apply traditional wisdom. First, not all trends are regular. In other words, while one type of support level may hold well in one uptrend, such as the popular 20-day moving average, in another trend, it might hold at a 10-day moving average because sometimes you have steeper trends, weaker trends, higher lows, and you have to always look at what type of trend you have and are they exhausting themselves. So most traders who pick up a book on technical analysis will run into the concept of trend formation and trend development. Trend lines are one of the most used and misused tools in a trader's toolbox. If you're going to use them, you have to have a consistent methodology that defines when you will draw them, where you will draw them, and what you will do when price touches them. Too many times I've seen traders draw random lines on charts with the argument that they might not use it, but it's good to have it there. I tend to disagree. If you don't have specific rules, then you will draw the trend line you wish were there as opposed to the one that should be there. If you do not have consistent rules, then you are probably just drawing random lines on charts, which cannot help your trading, but may make you feel better. Okay. But they won't actually help you. So first of all, we should define what we expect out of the trend. There are legitimate trend lines connecting lows of a move to highs of another move, drawn on the best fit effort through the center of the price action. Okay. Now, to draw a trend line, first we want to identify two swing highs or two swing low points and draw a line joining them together. There you have it. Now you have a chart that has trend lines. But wait a minute. Even though you can place a trend line based on two swing highs and two swing lows, the trend line remains unconfirmed until it hits a third. So in other words, you must have 3 points in common for this and no price breaking that trend line. So once you're able to draw your line on a chart by having 1 point in common, 2 points in common, you need to extend it out into the future and you want to wait for that third point to happen. So if you remember when we showed you that this same exact chart we looked at a little while ago, price was just here. We hadn't gotten the third point to confirm the trend line. Trend lines can be placed on any time frame, but they're more effective on longer time frames. Also, the longer a trend line is active, the stronger it gets. Now, as you can see here, as we extend out this trend line on the actual price chart, so here we have it where it touched down, bounced off of it, and moved up. So that's the same as this last white candle here. Then the market's turned downward. And there's no rule that the price can't break through the trend line. But when it does, it's telling you that that trend is ended because you cannot have any price going through your trend line. So you could redraw this trend line if you wished and wait for a third validation. But this trend line here is over and done with. You can't come back to it. You can't reactivate it because price has broken through it. So too many traders, though, want to draw what they like as opposed to the rules. Because you see here, this is the proper way and chart, the top chart, to have drawn this trend line. Find a swing low, extend your line out, no price breaking it, and then wait for it to be validated. But too many traders want to have a valid trend line right away, so they'll ignore this little action here and draw their trend line here. And when they do that, what they're going to do is as price comes down, they're going to expect a market reaction if price comes to touch this trend line. But the rest of the world is looking at this trend line, so the price reaction won't come to there. So trend lines give you basic market knowledge. And without this knowledge, you can't make really good decisions. And this is one of the few lines that helps you make smart market decisions. So tip number one, we want to draw a line connecting either two or more swing lows or two or more swing highs. So let's go over, I've got a live chart up here on the Euro US dollar for today. Let's go over, and I already drew today the trend line on there for you, but let me pop it up on your screen and we'll take a look at how you would draw the proper trend line. So this is a continuation of my chart that I've been doing for the last several classes on the Euro US dollar, and we see the support and resistance lines when the price was trading down in the lower range about the 108 level, but price has been steadily moving in an uptrend. And this is a very pretty uptrend. So what did I do? I came over here. I got my swing low right here, because a lot of people want to say this is the swing low, but it isn't. Because price then moved into a sideways moving action. Then price finally made its action. So this is the swing low that's important to us. And I extended that line straight out without letting any price break through it. And I got a price to come in here, a price here, a touch here, I got a touch here, and I got a touch here. So this trend line has been validated right here. And then when I saw it touch again here, I would have then been ready for that move. Now, we can see as price moved up, it's staying right on this trend line, moving up steadily. So if this price ended up easing down, we'd expect it to come down to that trend line. So this is just one of the first lines. This is like building your foundation. Okay, you need to get that first line on your bottom basement before you pour that cement. So you want to draw those important guidelines so that the house that you're building is squared. Otherwise, everything ends off in an angle and nothing works correctly. And this is what you're doing. You're building your foundation. You're squaring up that first piece of wood or that first piece of cement or the first thing you're doing before you start building that basement or that foundation or the support beam, so that everything is then on the right angles and squared. Okay. The same thing with your trend line. You're building information. So here we have our trend lines on our chart. We have old support and resistance, because I didn't go back because price of the euro has climbed well above where it's been trading. So it means I'd have to go back to several weeks ago or maybe a month or two ago to get something, see where price has been in this range. So here we have price back at somewhere around the 110 range, 111 range back in May 7th, but it only touched there for one day. So again, we'd have to go back farther and farther in order to find where price was trading last time to find support and resistance lines. Okay. But when we do that, we then have our trend line on here. We'd have our support and resistance, and we have our volume. So look at how volume has been steadily moving up right here with price moving up. That's telling you that the buyers are supporting this price movement. So that means that that price should continue to rise because the buyers are staying in the market pushing that price. So the trend line is helping you make some interpretations. So let's go back over to my PowerPoint. And so we've connected two or more swing lows or swing highs, and we have then waited for the third to validate it. Now, the more connecting points, the better. You've probably noticed that I've referenced two or more highs or lows in a trend line. The reason I mention or more is because the trend lines can continue to be relevant far out into the future. Now, the longer a trend line is and the more times that the price has hit that point, it remains valid or it supports that trend line. But statistically, it is more likely, the more times it hits that point over a longer period of time, the more likely it's statistically about to end. Because price isn't going to move up forever. And the more times it's tested that trend line, statistically, you're now running out of these tests. So if you've seen this trend line stay valid for quite some time, prices bounced off of it, you might want to consider that it might be going too long or too high in that price level. Then remember, 3, 1 point in common, 2 points in common. The third point in common is what validates that trend line. Every time you see price bounce off the same line, the more likely it is that others are watching it too and playing the same game you are. This can help you get several good entries in a row, but remember, trend lines won't last forever. So you want to make sure that you set proper stop losses to get out quickly if the support and resistance trend lines eventually fail. Tip 3 is you always want to trade with the trend. You want to buy into bullish trends and sell into bearish trends. I know it's easy to say, why? Or it's easy to say, look at that. I have a perfect opportunity to sell in an uptrend. Well, like I said, statistically, you will come out better. The trend is your friend. This steadfast rule also applies to trading trend lines. For experienced traders, this basically means we should only look to buy at bullish support lines and sell at bearish resistance lines. For traders not into the jargon, let the following images explain to you. When price is moving up, you would look to buy into each touch off of the price. Okay? Because when it bounces off there and you're looking for a sell point, you don't ever know when it's come to the top. And you don't know if it's going to fall right back down to the trend line. When it bounces off the trend line, you can buy at the trend line and ride it all the way up because you don't have to worry about it until it comes back down to that trend line again. So statistically, you'll make more points trading with the trend line than you will against it. Trading only in the direction of the trend will let you exploit potential trend line bounces as efficiently as possible. And while they won't always give you winning trades, the trades that are winners should give us more pips than what we had attempting to place trades against a trend. Coming full circle, trend lines are a very good, simple tool. You are connecting dots on a chart, but hopefully the 3 tips above will help you take drawing trend lines to the next level. Make sure that the trend line you draw are connecting 2 or more highs or 2 or more lows, but have not been broken by the price between those points. That is a crucially important point because too many of us, we're independent traders. We're sitting at our computers at home alone, and we're drawing these lines on charts, and we're pulling them all over the place. And if you don't follow the rules and follow them steadfast and you start letting your trend line slip, or you start drawing lines that you think are better, you'll find that you're ending up just drawing lines that you like, not lines that mean anything. And it's important drawing lines that mean something to everybody else, not just to you. This is one of the times that you want to be seeing what everybody else is doing. So whether you use trend lines or indicators, price action is what ultimately determines how much money we make. Learning about price action and how trends move is never a bad idea. Once we understand the basic concept of how price moves, then trend lines become a more effective tool in helping us analyze price action. Price constantly moves up and down, even within a trend. While most traders know this, they have a hard time applying that knowledge in real time. Traders often wait too long before entering buying near the tops of a price wave, panicking as the pullback begins and selling at the exact time that they should be considered buying during an uptrend. Trend lines can help us stop this. Okay. So as you notice on the chart, what happens is price is here. Price effectively moved all the way up to that. But what happens is because you didn't have a trend line drawn on properly, what happens is buyers tend to sell at this point and panic. Then they end up entering the market here and then selling again here. Okay. Instead of, if you have a valid trend line, you realize these are just bounces off of that trend line, and you then will make smart decisions. Well, let me just put this line back up. So here we have the price low. We extended it out. So we don't panic when price moves up here and then eases back down. We're not panicking. We're not jumping to get out of the market because we're waiting for it to touch that trend line and then bounce off of it. When you're doing this haphazard thing with these misshapen trend lines, you're buying at the wrong time and selling too early. And what you want to do is make sure you maximize each trade to get the most pips out of that trade. So trends tend to operate in a series of gradually moving highs and lows. Thus, an uptrend is a series of escalating highs and lows, while a downtrend is a series of descending lows and highs. Okay. So here in this figure, you can see push, thrust, push, thrust, push, thrust. Okay, we keep talking about it again, but what happens is too many traders enter here with the push, and then they panic here at the ease. Okay, and this is the wrong thing. You should be expecting these. Okay, because a trend will work better when you have these just as they are, and as long as you're getting the push, the ease, the push, the ease, the push, the ease, this is what a trend line will do, and this way you can get in here and get out here instead of panicking and trying to figure out, is this a retracement? Is it a continuation? Is it a reversal? So when you combine trend lines with things like Japanese candlesticks or oscillators and indicators, or you just look at the volume, okay, you'll be able to tell whether you're looking at a retracement or a reversal. So it's very, very important because a reversal is telling you to get out of the market. A retracement is just telling you to sit tight. The price is just retracing a little bit. Hold on a second, my marker won't turn off. There we go. So one of the best reasons to learn how to read a chart properly is so that you can apply proper technical analysis. Not every trader believes in using technical analysis, but it can be useful even if it's not your primary method of trading. Technical analysis relies on the price that is on the chart you're using. Now, most charting systems will allow you to add all kinds of technical analysis tools. But like I said, you need to do trend lines, you need to do support and resistance lines, and you need to watch volume. From there, you can do all your overlays. You can add on all your different strategies. You can add on your different indicators and oscillators. But these three pieces of information will help you get the foundation of the chart. It will also help you start understanding the personality of the asset that you're looking at. Now, remember, trend lines also show three distinct but related pieces of information. They show the direction of the current market, uptrend or downtrend. The strength, or more precisely, the speed of the market, which is critical. That is how steep that trend line is, how fast is this moving, and it will also show you future support and resistance of the current price movement. These pieces of information can be used independently of each other, or they can be used together as part of a larger trading system. So remember, we have direction of price movement, strength of price movement, and support and resistance. Now we want to learn, once we put our trend line on the charts, to read what we call breakouts. Okay, we have breakouts. Breakouts are one of the most common techniques used in the market in trading. They consist of identifying a key price level and then buying or selling as the price breaks that predetermined level. The expectation is that price has enough force to break that level, then it will continue to move in that direction. Okay. So once you have your trend line on the charts, we want to look at price patterns and trend patterns. And I think 2 weeks from now we have the class on trend patterns and chart patterns. And we'll be looking at everything from head and shoulders to triangles to breakouts to retracements to continuation patterns, so that once you have the basics or the foundation on your chart line, on your charts, you can then start applying some basic technical analysis and analyzing how price should be and where you can take action and reaction. Okay, where and when you apply wedges and triangles, you can actually define then your entry points, your exit points, and how much the price movement should be when it breaks out of those points. So learning breakouts are very, very important. And using your trend lines and your chart patterns together, you'll be able to make smart trading decisions. So in that next class, we'll learn how to, after support and resistance, we'll learn how to look at breakouts. We'll learn what retracements are. Okay. We'll learn how not to panic when we see the trend and price retracing. Because again, if you see right here, if you entered the market here, you should have stayed in and should have maxed out right here. Okay. You had a beautiful trend line, but you want to avoid this panic. You want to understand what this means as a retracement as opposed to what it means as a reversal. And you want to be able to foresee these, and your trend lines will help you with this. And then we'll also look later this month looking at adding Fibonacci levels onto your charts so that you can actually calculate the retracements. But you need to get the basics of trend lines on your charts first, and then support and resistance, and then we can do the rest. So in our class on trend patterns and price patterns, we're going to look at also reversals. And reversals are very important because we want to know when price is reversing itself or is it just retracing itself. And we'll look at all the patterns. And if you come to our class on Japanese candlesticks, they are a great combination to use with trend lines, because when a candlestick tells you the market's losing its momentum or gaining momentum or which way it's going to go, when you see that bounce off a trend line or the break of the trend line, you can then make very smart trading decisions. So what you want to do is be able to spot the reversal point in a trend line. And you do this through several different types of indicators, but one is primarily seeing retracements and reversals, and applying this with Japanese candlesticks is a great way to identify these important price levels and price action. So next week we're going to start looking at support and resistance. Support and resistance is a common jargon for areas on a chart where price has a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like price ceiling that prices cannot break above. So on that note, I'm going to leave you all tonight. I hope you learned a little bit, and my recommendation for everybody is to take one asset, not even an asset you necessarily want to trade. Say you're going to Australia on vacation, so take the Australia against the pound. Okay? Or, well, Australia, what do they export? They export lots of minerals, so take copper. And whatever you want to take whatever your favorite asset is, and start drawing your trend line on there, and use the same chart each week, like I showed you the euro US dollar. For each week, start adding these things onto it, and getting to know the personality. Because once you've mastered all this, you can then move from one chart to the next to the next. But it's learning it and paying attention to it and learning to put long-term and short-term and medium-term trend, because you can use all different time frames, and you can also look at longer-term trends within shorter-term trends within longer-term trends. Because let's go back over to my Euro US dollar chart again real quickly. Okay. So right now we see the euro moving in a very strong uptrend. But that's only showing you what you got for a couple of days. We saw it came off of a downtrend. But let's go click onto a one-day chart and see what the longer story is. So now we can see the euro is actually recovering from a very steep ongoing downtrend. So we could have actually put our Fibonacci levels on here, back here, from here to here, and then projected what price points would have been important. So you can see in my chart when I drew these old support and resistance lines, this orange line, look how important that price point was here at 110.262, and that line has been on the chart for months. Okay, but because it was an important price point way back then, look at these trend lines. The one we just drew today, it's still very valid on the charts. Okay, and once you start working with these, you'll be surprised how important they are. So you can look at short-term trends within longer-term trends, and looking at longer time frames and drawing longer-term trends helps you better understand that asset. Because you may say the asset is in an uptrend. The euro's been in a very strong short-term uptrend, but it's part of a very long-term downtrend. When you know where that downtrend is started and running to, you can then use that to help calculate where this short-term uptrend should go. Because you'll probably find that this uptrend today and these prices were very crucial and you could have predicted them probably fairly accurately using Fibonacci levels you would have drawn from this point, connecting this high to this low. Okay, and so you should come to our class on Fibonacci retracements also. So on that note, I'm going to say good night to everybody. Thank you very much for joining us. I'll see you on Sunday. We're going to be looking at the economic events that are on the schedule for the balance of the month. And we're also going to take a look at what action we might see with the pound as the election comes near, but I think it's a shoo-in. But it will cause a wee bit of market volatility. So hopefully we'll see you on Sunday. Good night now.